All right, ladies and gentlemen, today is December 15th, 2021, and I'm back with another edition of the Wednesday live show. And lots going on in the market. Today is Fed Day, and as you know, Fed days are typically crazy. The market's really been acting weird lately, too. And while the S&P is basically right up near the all-time highs in the history of the world, as you probably are aware, the majority of stocks are not participating, and a lot of stocks have been clobbered lately, especially growth stocks, tech stocks, your average sort of, well, just basically your average stock. And interestingly enough, I have a slide here that shows that. Oh, let's see, where did I put that slide? Um, Here we go, right here. I thought this was pretty interesting. I saw this slide this is a couple days ago, maybe it was yesterday, but basically it shows the distance from the 52-week high for the average stock in the various indexes, and it's basically kind of confirming something that we've all been seeing under the surface is that and so like what this is telling us is that 39%, let's see, average 39%. So the Nasdaq is only 3%, 3.6%, but the average Nasdaq stock is 39%. And so there you go. Nasdaq Composite, Nasdaq 100, the S&P. So the average S&P stock's like down almost 12% from its 52-week high. And of course, it's just, an average. And so, but it gives you kind of a good idea. And let's see, I don't see a date on this, but yeah, this is about where we are. So anyway, small caps down significantly. So if you think about that, I mean, there's a lot of stocks that are, and here's this. I know we look at this on the show kind of frequently. This arc here. This kind of reinforces that whole idea. So there's the 52-week high back in February, and you can see where it is now. And this is comprised of all those really super hot growth tech stocks, innovation type stocks, and so just a ton of them have been slammed. And as everybody knows, it's a handful of stocks holding up the indexes: Apple, Microsoft, Google, Amazon. Funny thing is, I was looking at Amazon. Look at this. Amazon really hasn't done a whole lot this year. Let's see. I think I can just hit year to date here somewhere. There we go. So year to date, Amazon is just barely up, just a little bit, which is interesting. So basically, so goes Apple, so goes the market, right? And Apple's got like a little spike pivot high up here. So, and of course, today being Fed Day adds a whole new dynamic to everything because the market itself. Let's just look at the SPY here. We had a little sell-off here. So this is year to date, which is kind of convenient, but we had a little sell-off a few weeks back, and I believe this was somewhere in the neighborhood of 4 to 5% on the S&P, and it varied by index. And kind of weird, that little sort of spike high reversal bar there was kind of interesting because you don't see that all the time. I mean, that was the all-time high in the history of the world, and so we got pretty decent little sell down from that and some major volatility here. I mean, some long range days, and then the market managed to pop back up, right? And so now it's, there's this huge amount of resistance up here, like right up here, slightly over 470. Let's look at the SPX. So the SPY. So anyway, you can see it. I could draw like a big overhead resistance line up there, ignoring like that little spike up there. And so it's, just slightly over 4,700. Let's see, I'll go ahead and put that line on there. So, call it 4720 or something like that. Um, Big overhead resistance line, no huge big deal. But one of the more interesting things, to me anyway, is the Russell 2000. Because, as you can see on the chart, and as we've discussed lots of times here, the Russell 2000 spent the whole year kind of trapped in that box, right? And then finally broke out of the box to the upside, and that was, according to most of the technical analysis books out there, that breakout. Theoretically, let me go back to a year to date here. Theoretically, when you get a big range, especially for that amount of time, and you break out of it, sometimes it just takes off and makes a significant move. Sometimes you get a little pullback to test the upper end, but when it sort of failed in the upper part of the range and fell back down, and now look at it. So if it wasn't for like this sort of like right out of the box at the beginning of 2021, way over here on the left side of the chart, you can see right out of the box the Russell 2000 kind of took off right at the beginning of January, and so like just those couple of days right there, those few days that you see are going to account for, well, and I mean it's still, we still got couple of weeks here until the end of the year, so it'll be interesting to see. But basically, if it were to close now, the whole gain would have come from just 1 week at the beginning of January. So, and the more interesting thing is the way that this thing is sold down towards the bottom end of this box. I mean, it looks to me, just a casual observation of the chart, it looks to me like it spent roughly half the time. If you look at like the midpoint of this box being, say, 220, spent about half the time above it, and maybe a little bit more than half the time above it, and maybe, a third of the time below it. So kind of interesting, but anyway, the sell down here recently from these highs, not extremely encouraging, considering this is 2,000 stocks, right? And of course, the S&P and even like the Nasdaq. We'll just pull up the Nasdaq 100, the Qs here. Just a handful of stocks holding this thing up. So anyway, it's made for an extremely tough trading environment for individual traders, chasing around different stocks, because there's been, I heard him talking about Roku here recently. Here's an example of a stock that, let me zoom out a little bit. Yeah, I mean, these kind of monster stocks that had these huge moves or whatever are having like a really rough way to go here. And there's just tons of them. I mean, what's that? Zoom? Look at Zoom. This was one of the darlings of the 2020 pandemic because everybody was teleconferencing, right? But I mean, look at some of these things. I mean, it's just incredible. And so, see, it's lost well over half its value from the high. So anyway, that slide I showed you was, I mean, there's example after example after example of stocks that have been just crushed. Here's one that I like to look at, is this KWEB, right? This is basically, it's an ETF of all the China stocks, right? And so this gives you a pretty good idea of what's possible out there. And so there's a lot of stocks that they just made these insane moves, and then they peaked out and they've already crashed, basically. I don't know what else to call this. The craziest thing about this, and of course, the Chinese stocks, they have their own issues and problems and that. So that's a whole nother thing. But it's just it's an eye opener to look at this, because the current price is hovering right down around literally the pandemic lows. So stocks like Alibaba, right? I mean, Alibaba, amazingly enough, is trading well below the pandemic lows, which was back over here, right? When, if I'm not mistaken, March of 2020. And look at that. And so there's a lot of market cap destroyed there, because this was a widely held institutional stock. And obviously I remember when this thing IPO'd. Be honest with you. Let's look at the weekly chart, see if we can get the whole history. There we go. So it's up from the IPO in 2014. Not much. I mean, if you think about it, IPO'd and kind of ripped higher to begin with, and those levels shortly after the IPO have been tested here recently. But this was sort of has been an institutional favorite, and you can see why, right? It's made some significant moves, but anyway, the whole point is that there's just hundreds and hundreds and hundreds of examples of stocks that have just been decimated. Meanwhile, the indexes, let's look at the Dow here. See, INDU, I believe is the ticker symbol. Yeah, the old Dow here, hovering right up at the highs. Little sort of sell down here and rallied back up. So, but here's the thing: is what I was saying before. Fed days, Federal Reserve, FOMC day, Fed announcement days, tend to, in the past, they've been turning points. There's been lots of, and I forget which years specifically, but in the past, I remember looking at charts, and there was a lot of sort of turning points, major turning points in the market that happened on FOMC days, right? Like the market would be going one direction, and then it would rally up and rally up and rally up, and then you'd get a Fed meeting. And of course, this was back in the Janet Yellen days. But I had another slide here that this is kind of interesting. This slide here is telling us what to expect from the Fed announcement today, right? And so it says markets are anticipating the Fed will speed up its wind down of its bond buying program, changing the end date to March from June, right? So maybe the market's priced that in, but this next part kind of blew my mind here. Free central banks up to start raising interest rates from zero, and expected to release a new forecast showing 2 to 3 rate hikes next year and 3 to 4 rate hikes in 2023. And so, so this is saying that the markets are anticipating the Fed is going to forecast, 5 to 7 rate hikes on deck here. And with the market hovering up at the highs, it seems a little odd to me that the market could possibly be forecasting that. But here's the thing, right? And this is the kicker. Central banks should also acknowledge inflation is no longer transitory or temporary, and rising prices are a threat to the economy, right? And of course, we know the CPI rose 6.8%, and like the other day, the PPI was up like 9%, 9 point something percent. So anyway, so here's the takeaway: is the Fed has let the inflation genie out of the bottle, and for all those years, they kept complaining about, trying to get to 2% inflation and 2% inflation goal, this and that, and all that jawboning. And then, so, pandemic comes along. Something like 40% of all the money, U.S. dollars in existence, have been created in the last 12 months or something like that. I mean, that's, you know what I'm talking about. And so anyway, long story short, the Fed is in a pickle right now, and inflation is running hot. And like it says here, threat to the economy, right? I mean, and inflation's probably running double digits, right? Based on my observation at the grocery store. Um, it's nothing. Every time I go to the grocery store, it seems like some of the stuff that I buy has gone up. Stuff that was two something is now three something. Things that were 2.49 are now 3.29, and so and that goes all the way to all the way up the chain to home prices, which have been rising at a crazy clip, and rents and that. So anyway, the Fed has let the inflation genie out of the bottle, right? And so, whoops, accidentally hit something on my keyboard. And so anyway, long story short, it's time for them to start taking away the punch bowl. But you look at the market, and the market's like, acting like everything's fine. The market is acting like, Fed's gonna, and here's the thing, the Fed has ever since that pandemic sell-off. I mean, they panicked, right? Like right here when this thing fell like 35% in a short amount of time, the Fed came out with both barrels, right? Remember they had it was either Powell or Kashgari on 60 Minutes saying the Fed has unlimited cash to throw at this thing, and so I mean they did an emergency rate cut, lowered interest rates to zero, and threw trillions of dollars at this market. And ever since then, the perception has been that Fed's got your back. But here's the big problem: is so now they're in a pickle. Inflation is running the hottest in 40 years, and people are nervous about that. I mean, it's hitting them in the pocketbook. The cost of living's been going up, every day since I've been born, and my entire adult life. It seems like the cost of living goes up, the price of stuff goes up, but CPI hasn't really reflected that, and for any number of reasons, I won't get into all that, but long story short, when the Fed goes into a tightening cycle, which they're basically forced to at this point, then, perceptions change. But here's the thing, is like they're talking about raising the debt ceiling now. I've lost track of what the debt, I mean, what's the national debt? 29 trillion or something crazy like that. I think it went from 27 to 29 trillion. And anyway, I read something last night that was talking about how much debt there is out there just in the system, not just the federal debt, but debt in general that is financed at almost at 0% interest rates. And of course the whole bond market. So when you get into an interest rate cycle, and don't forget that the expectation, like I just showed you there from a CNBC article, is that they're going to raise 5 to 7 times in the next in the next 2 years. And so, the cure for rising inflation is a recession. And so, a market with this sort of trajectory doesn't just keep going up at a 45-degree angle, in a period of rising interest rates and or a recession. And so it's going to be interesting to see, how it manifests. Now, here's the thing is, we're getting really close to Christmas and the holidays, and it's hard to imagine Powell, coming out too hawkish right before Christmas, right? He doesn't want to be the Grinch that triggers this humongous market sell-off. So he's got to tread really, really cautiously today, and it's going to be fascinating to listen to hear what he says, and more fascinating how the market reacts. I mean, the market, and the funny thing is that it's no huge mystery that there's all this weird stuff going on. Like the market itself is sort of priced for perfection, right? And recently, all along the way here, you've seen all sorts of, and I don't know if you've seen them, but I've seen them. I think Goldman Sachs has like 12 valuation metrics that they use to determine whether the market is, cheap or expensive. And so, um, and there's like the Buffett indicator. Anyway, the market's never been more expensive. And so like the Buffett indicator dwarfs the housing bubble and the dot-com bubble as market cap as a percentage of GDP. And so there's lots of stuff that could go wrong. So I would urge you to be aware of all that. I mean, hey, every single thing that this market's had thrown at it, it's managed to recover. This particular sell-off here, kind of amazes me. This basically the pandemic sell-off, which was pretty much justified. The most interesting thing about that is, and if you recall, way back then, we got this. We knew that there was COVID in China or whatever, and there was this little sell-off, and then the market pretended it wasn't going to matter, right? And then all of a sudden, one day it did matter, and then you got that huge tank. And quite frankly, if the Fed hadn't intervened, there would have been no way it would have rebounded like that and made this move. So this is primarily Fed intervention and propping up the market during the pandemic. They're pulling out all the stops, doing anything they could. So, all right, well, real quick here. So, not a whole lot going on. We have one open trade here in Johnson & Johnson, which triggered in. And the funny thing about this is that this particular trade here, and this is looking good too. I mean, this is beautiful. Quite frankly, it's sort of turning out. I sort of thought, and the system identified this way back over here. Geez, I think it was. I'd have to look again, but let's see, date 12. What triggered in on 12/9? I forget exactly which date this hit the pending list, but it was back here in like September, if I'm not mistaken, September or October. And so theoretically, you get that sell down and then this rebound, and it would have taken sort of looked like this area here, sell down and then trend resumption or rebound or whatever, but it turned into like one of those big sort of W patterns. Even more recently, we had kind of even more recently, we took out like those lows just by a little bit and bounced, but these W patterns are powerful, and so this is looking really good, quite frankly. And I would expect that trailing stop's going to be tightening up here any day now. So it was up 3% in a really tough market here since it triggered in, and looking pretty good, especially for a stock that has a very, very low sort of beta. And so we still have the one pending stock. It actually had a pretty good look to it here recently. Came down, fluttered around the 200 days, started to bounce, and I thought I had a trend line on here. It's not that easy to draw a trend line. But anyway, long story short, just this past week, along with a lot of other stocks, it's sort of sold down and retesting this. So trigger price is up here. It got really, really close, but never triggered in yet. So bigger scheme of things, still a decent look here. I'm gonna guess if it loses this prior low here by much and doesn't almost immediately bounce back off of it. See, look back over here. It's sort of a similar pattern. Sold down, had a little bounce, kind of retested the lows, and then turned back around. But we'll see what happens here. So if it drops too much more from here, then it'd probably get removed from the list. So anyway, that's about it. Well, let's see. I was looking at some recent IPOs. Here's one, Coinbase, right? Like there's the IPO, got washed out, started to rebound, came up pretty much, and then looking nasty here. Let's see, Robinhood, another IPO, um, just exploded out of the gate, and now look at the thing. And so, man, there's a lot of disasters out there. IPO. Um, so here's the Renaissance. This is the IPO ETF. This is kind of interesting because, man, this was coming off of the pandemic low. This was hot, right? Look at that. Coming off the pandemic low, IPOs were really hot last year, and then at the beginning of this year, and then things have kind of settled down a little bit. And so basically, this ETF holds a bunch of stocks that have IPO'd recently or whatever. And so this gives you an idea of like sort of the recent performance. Amazingly enough, right? Let me go back to my year to date. So, this thing's down year to date. The indexes are up significantly, as are commodities, right? I mean, I should have brought along a chart of all the different commodities, right? Because pork bellies that they make bacon out of, and copper, and all the different things that go into tangible stuff are crazy. Let's look at steel. Let's see, steel SLX, I believe, is the steel ETF. Yeah, it's been kind of drifting down a little bit too. So coffee, I recall seeing, yeah, look at that. There's the price of coffee this year. This is not the greatest ETN in the world, but it gives you an idea. Coffee price has been rising. So yeah, so the Fed needs to fight inflation. Fed's going to raise interest rates, they're going to talk about raising, quitting the tapering, ending the tapering, and setting the stage to raise rates. And so it'll be interesting to see if the market shrugs that off. And the biggest problem is that, they're behind the curve, right? Because we've kind of had the post-pandemic sort of, relative return to normalcy, although it looks like things are sort of going the other direction. But here's the thing. If the economy starts slowing down, which it very well could be, at the same time that the Fed's raising rates, well then, you got a mess on your hands. The old stagflation comes to mind. So it's going to be crazy and interesting to see what happens. So anyway, I would be super cautious, and hopefully, I mean, theoretically, we're in the strongest period, and it's hard to imagine the market going down. The only time I can remember was 2018, where the market actually sold off hard into the end of the year. Almost every other year, you can practically count on, good price action and stocks behaving well into the end of the year, because just, the Santa Claus rally, all that good stuff. Seasonally, it should be a good time of the year. So anyway, hey, who knows? Maybe the market will act well into the end of the year, and then I'm mostly worried about January of 2022, because there's a lot of people that don't want to sell this time of year because for tax purposes, but they're thinking, okay, if I can just hold on a few more weeks, then come January, I'm gonna take some off the table, right? So anyway, there's a lot of stuff, a lot of moving parts and a lot of pieces to the current puzzle, and so we'll have to see what happens. But today is going to be fascinating because that we get to hear what Jay Powell's got planned as far as fighting the inflation that basically they created, right? I mean, they obviously they blame it on supply chains, but when push comes to shove, the Fed has done everything they can to get inflation up to 2%, and then they overshot it obviously, and so they've painted themselves in the corner. They got a mess in their hands, and whatever the cure for inflation is, it's generally not good for the market. And here, the last thing is that, in an inflationary environment, the market tends to do well nominally. I mean, it tends to stocks are the one thing that over long periods of time, historically anyway, have kept up with inflation. But at the same time, the last time that we had an inflationary scenario like we're looking at now, the market did horrible, which was back in the 70s. So I'll have to do a little studying up on that. Anyway, thanks for tuning in. I will see you back here. Yeah, I'll do a show next week. It'll be a couple days before Christmas, but no big deal. I can come on and chat for 30 minutes, and we'll be able to look back and see, how the market reacted to Mr. Powell's speech today. So anyway, I'll see you back here next week.